Welcome back to Morning Trade Live. We're seeing whether or not we can get 3 days in a row of gains. We've had some back and forth action already today, and we have a name to watch, and that is United Airlines. It's time to go inside out of United Airlines. The earnings are due out this afternoon. What will the company say? And we've seen the stock well off the highs, which hit $116 not that long ago, but has sold off. So I can't wait to hear more from Nicolas Owens, industrials equity analyst at Morningstar Research Services. Thank you so much for being here. I mean, this stock has certainly tanked, for lack of a better word, down about 37% in 3 months. Some of your thoughts on what the company may say. What are you expecting today after the close?
Thanks for having me, Nicole. So my guess is they'll have an okay quarter. Granted that first quarter is usually their softest anyway, just for all airlines. Something in the order of 13 billion of revenue. Their guide has some 70-something cents of earnings. It could come in softer. They don't have as much detailed guidance as Delta did. So whether they suspend or not, wouldn't matter too much to my outlook. I think the thing that has become part of the story is that going into March, it seemed like bookings were a little softer and people might be not as willing to spend. And I just see that as kind of returning to a more normal state for the airline industry. We can talk about how, the last few years have been an unusual gravy train for them. And so it's just, the new normal. If we end up with a recession somewhere here in the next year, we're kind of due for one, So airlines being macro sensitive, they might see some of that.
You mentioned Delta, and I was thinking how Delta said they were expected fewer domestic travel demand and such. But the big picture is these airlines have been preparing and preparing. They hedge on their fuel. They get fewer jets and pack them up. You never can get one seat. They had pricing power. They stopped flying to some of the areas that were less demand. I mean, haven't they been doing everything to squeeze out? I don't know what you get on the airlines, but I know you have to pay for it. You could pay top dollar for a seat and still pay $40 for a bag. And I only speak for myself because I do it. So you tell me, they're not doing well enough?
Well, I think it's a really great question. It's important to think of, for all these bigger airlines especially, their customers are a blend, right? So you have people who are paying top dollar for the front 5 seats or whatever, and that probably won't change. But it has to be kind of the average seat price on that fills the plane is really what makes or breaks what it costs for them to take off. Now, fuel prices have actually come down lately, so that's a little bit of a buffer for them, as a group. And in fact, I was looking yesterday at the TSA, how many people come through the gates through yesterday or through Sunday. And it looks to me like it's on par with 2024. So I don't know that it's softness in terms of people showing up, but it might be the price they were willing to pay for that ticket. The idea of a last minute full fare booking might not be as popular right now, especially if people are just a little bit uneasy or sitting on their hands and making these long-term travel plans.
You have 2 stars, $39 fair value. This stock is at $68. So could we see a big move even in the next 24 hours after the earnings, downwards?
Sure. I mean, if it looks like consensus is about a penny below their last guide, I confess I'm a bit bearish on the name. What the market does with that, I think it'll have a lot more to do with their comments about the rest of the year or what they're seeing in terms of summer bookings. That's going to be more important than what they did in January or what have you. My thesis overall is that the sort of gravy train from post-COVID is probably over, and a more normal supply and demand equation is not good for the industry's profitability. And they're doing all those things that you said, especially in light of having to cut capacity, so they can't grow their way out of it. Divide by more miles to get a better unit profitability equation. And all those things they're doing are rational things you got to do to run a business. But at the end of the day, if someone who was willing to pay $750 for an airfare a year ago is now thinking maybe 500 is the number they have in their head, that makes a bigger difference to their bottom line.
And just like the laundry list, business travelers, more or less, demand for summer, more or less, and is there a real winner in the group?
Well, it is fair. It's important to point out that I think United has done a good job segmenting. So, like having more, with the loyalty program, and even though it's sort of one person's nickel and diming in terms of what you have to pay for to get on the plane, is also successful segmenting in terms of picking off what are people willing to pay a little bit more for. So I'd say United and Delta are kind of the leaders of the pack in that regard. And so the industry could be unprofitable or break even in the next year or two, and these two might still make money. But for Q1, I'm thinking they'll be happy to break even on an operating margin basis, maybe 3% operating margin. 10% for the year would be great. And I don't see them growing that margin over time, just given the conditions that we're likely to face.
Right, understood. And are you seeing business travelers this year? Yes or no, or hard to say?
They're out there. I mean, the traditional definition has morphed a little bit in terms of how do you what they used to do is how they price that. That's also one of the first things companies cut if they think they're heading into lean times.
Right. And I know that they were also saying people were traveling on business and then would stay for leisure and sort of maximize the trip that the company, half paid for. Nicolas Owens, nice to see you. Morningstar Research Services. Thank you very much, Nicolas.
Thanks.
We want to go ahead and trade this name. So we're watching UAL very closely. I mentioned how it was at $116, now it's $67, and you saw he had a $28 target. So let's have Tom White, host of Fast Market. And you have a bullish example trade for us today. Different story than what he's telling us. I'm curious to see the trade. Good morning, Tom.
Good morning, Nicole. Yeah, a little contrarian here, just based on the fact that I just got off a plane and the airport was full, the plane was full. They were trying to give money away to get people to kind of push back to the next flight. So, if you think the stock that's pulled back over 40% from those all-time highs in just 3 months is due for a little pop, and we saw that with Delta earnings last week. So this is really short-term positioning. I know your guest has a longer-term view on maybe what happens in case there's a recession. This is just a couple of example trades based on really short-term positioning, based on earnings. Option market's pricing in about a plus or minus 8% move in the shares post-earnings. So I looked at, first strategy was bullish call diagonal here, where I can offset some of my costs, take advantage of a little bit of vol dispersion here too. Going out to the April 25th weekly cycle that expires in 10 days, and we're going to buy the 66 strike call there. That's in the money by a couple bucks. And then against it, about that 1 standard deviation move, sell the April 17th monthly options that expire in just a couple days here, the 71 strike call, so a bullish $5 wide call diagonal. You're going to pay roughly about a 330 debit. It's probably trading a little bit higher than that right now because the stock has continued to move higher here at the start of the session. So if you pay that 330 debit, there's your risk. A break even about 68. That's where the stock's basically trading right now. Even if you do pay a little bit more, it's a $5 wide call diagonal, so you're paying less than the width of it. Now, why is that? Well, you're buying about a 95% implied volatility level in the April 25th 66 strike call, selling about 145% in the near term April 17th weekly options on that 71 strike. So that vol dispersion lowers the entry point. Anything above that 68 level or about that 68 level is going to be profitability on this one. So really short-term positioning if you think this thing's going to pop post-earnings, about that 1 standard deviation.
Okay. And look, I mean, that's the bet. Maybe you do get a pop after a huge sell-off in 3 months. It's down almost 40% in 3 months, to your point about Delta. Maybe this is a good example trade here to the bullish side. You get that short-term pop. Then you also have a more neutral approach example trade here. Tell us a little bit about that one, Tom.
Yeah, same concept. You're trying to take advantage of the volatility in this name going into earnings. So this is a complex four-legged spread where I'm going to sell an out-of-the-money put vertical to help finance the purchase of a slightly bullish call calendar here. So going out to that April 17th monthly options that expires in just a couple days. And we're going to sell an out-of-the-money put vertical, the 64 put. We're going to sell that one and buy the 59 put. So a short $5 wide put vertical. And that's going to help finance the purchase of a 1-week wide call calendar on the 71 strike, buying the April 25th 71 call, selling the April 17th 71 strike call, so just 1 week wide. As a credit that you're going to collect on this four-legged spread, I've got 50-cent credit on it. It's probably trading closer to maybe a dime or 20-cent credit, but that credit is because you're selling the put vertical to help finance the call calendar. You can see here from the risk profile, the apex of profitability at or near that 71 strike, just kind of like the call diagonal that we just looked at. But it's a little bit more neutral where I've still got some cushion to the downside, that 63.5 break-even level to the downside. So I can still, even if the stock opens up relatively flat, maybe even down a little bit, I can still be profitable on this one. Where I start getting hurt is below $63.50. I've got about $450 in risk if you collect a 50-cent credit. So this might be another strategy that you can use to take advantage of a grind higher. But this one, even if the stock kind of stays here post earnings, you're going to be profitable on this one.
Okay, and Tom, I'm really excited to hear more from the conference call and what they may say. I saw that some of the analysts think this is the quarter where they swing to first quarter profit despite slowing travel demand. We also have this new element about Canada, right? Fewer people coming from Canada to the U.S. Down air travel slipping 13%, driving even more. Those driving road trips down 30%. So it'll be interesting to see what kind of comments they make about the future, if any.
Yep.
Right, they may not even give us good guidance.
Yeah,
all right, Tom, clear guidance. Tom White, thank you very much.
Thanks.
Nice to see you and welcome back.